All right, let's get right into it. The Indian stock market is getting absolutely hammered, and you might be wondering why. Well, it all comes down to a military conflict happening thousands of kilometers away. Today, we're going to break down exactly how that's possible and, more importantly, what it means for your money. So here's how we're going to tackle this. First, we'll look at the geopolitical trigger, the why behind it all. Then we'll get into the economic fallout here at home. From there, we'll check out the market's playbook, who's winning and who's losing. Then comes the big one, the investor's dilemma. And finally, we'll see if history has any clues for us. Okay, first things first. To really get a grip on why the market is panicking, we have to look at the single event that basically lit the fuse. And wow, look at how quickly this all blew up. It literally went from 0 to 100 in just a few days. It kicks off on February 28th with Operation Epic Fury, a strike that kills Iran's supreme leader. The very next day, March 1st, Iran hits back. And this is the crucial part. They announce they're closing the Strait of Hormuz. A day later, coalition forces strike back at Iran's key facilities, and boom. By March 4th, Brent crude oil prices have surged nearly 17%. Just like that. Okay, so let's talk about that waterway I just mentioned, the Strait of Hormuz. You really have to think of it as the world's oil artery. It's this tiny, narrow passage, but it is the most critical choke point for global oil trade. And that threat by Iran to shut it down, that's the main reason a conflict over there has these immediate and really severe consequences for the entire world. And this is where it really hits home for us in India. I mean, look at this. We are massively dependent on imported crude oil, about 85% of what we use, and a huge chunk of that, over 40%, comes right through that now threatened Strait of Hormuz. So this isn't some far-off problem, It's a direct threat to the energy supply that fuels our entire economy. All right, so we've got the geopolitical shock. Now, how does that shockwave travel and turn into actual economic pain right here in India? This right here is absolutely key. It creates this vicious cycle, a really nasty feedback loop. So step one, oil prices surge, right? That means India's import bill gets way bigger. Step two, to pay for all that expensive oil, we need more US dollars, so our trade deficit widens. Step three, that huge demand for dollars weakens our rupee, pushing it to a record low of 92.15. And here's the kicker. Step four, now that the rupee is weaker, buying that same barrel of oil costs us even more, which just pours fuel on the fire of inflation for all of us. And that vicious cycle, it has a price tag, and it is staggering. We're talking about 11 lakh crore rupees. That's the total amount of wealth just wiped out from the Indian stock market during the sell-off. Let that number sink in for a second. It's almost hard to wrap your head around, but it makes the impact on investors painfully clear. In a situation like this, it's important to remember that the market doesn't just fall in a straight line. Not everyone loses. It very quickly splits into two different camps, two different zones. You've got the red zone. These are the sectors that's super high risk. And then you've got the green zone, the places investors run to for safety. And here's the proof in the numbers. It's pretty stark. Look at the red zone. Aviation, right? Indigo is down almost 7% because, well, their biggest cost is jet fuel. Same story for paints. Burger Paints is down over 5% because so many of their raw materials come from crude oil. But then, look at the green zone. Money had to go somewhere, right? It fled to safety. So you see defense stocks like BEL actually ticking up because they're seen as a hedge. And of course, gold, the classic safe haven, jumped a solid 3.5%. So all of this, the volatility, the split between winners and losers, it forces every single one of us as investors to face a huge, critical question. All right, so there are two ways to look at this. First, you've got the realist's view. Arun Kejriwal sums it up perfectly here. Basically, the thinking is there's just too much uncertainty right now. The conflict could get a lot worse, so the smart move is to be cautious, maybe sell off some risky stuff and just hold on to your cash, your dry powder, and wait for the dust to settle. But then you have the complete opposite take, the opportunist's view. These guys see all this panic, and they don't see risk, they see a massive sale. Their argument is that great, high-quality companies are being unfairly punished just because of fear. And as this quote says, the people who sell in a panic are almost always the ones who miss the big bounce back. So who's right? The cautious realist who's holding cash, or the bold opportunist who's buying the dip? Well, maybe history can give us a clue. Let's take a look. And when you look back, the pattern is pretty amazing, and it's really consistent. Go back to the Gulf War in '91, the Kargil War, even the recent Russia-Ukraine conflict. It's the same story every time. You get this sharp, painful, knee-jerk sell-off.
But then it's followed by a surprisingly fast, V-shaped recovery as soon as that initial panic starts to fade. In pretty much every one of these cases, the markets were way higher just a few months later.
Which brings us right back to the ultimate question, doesn't it? We've looked at the trigger, we've seen the economic fallout, and we've checked the history books. So now it really comes down to this. Is what we're seeing the start of a long, painful bear market, or is it a massive buying opportunity in disguise? The choice you make right now could define your portfolio for a long time to come.